Hello, everyone. Welcome to our podcast series. I'm Nova Lui, Head of Investors Advisory from RHB Bank. Today, we will discuss with everyone as we are seeing renewed opportunity in AUD-denominated asset with lower entry points and relatively higher bond yield compared to many other markets. To help investors capture this potential, RHB Bank, in collaboration with RHB Asset Management, has launched the RHB Focus Income Bond Fund Series 10. Joining me today is Mr. Roy Ng, Head of Fixed Income Global at RHB Asset Management, and also the portfolio manager for this fund. Roy has been with RHB Asset Management since 2018, managing a wide range of global and local fixed income mandates across wholesale fund, unit trust portfolio, and discretionary mandates for retail, corporate, and institutional investors. He brings with him over 20 years of experience across global and Asian REITs, credit, FX, and derivative, having previously worked with Citi Global Market in Sydney, Hong Kong, and Singapore. Roy holds a Bachelor of Law and Commerce from UNSW and is a licensed CMSRL fund manager. Thank you for tuning in. Closed-end bond funds are not something that you see often, but RHB Bank has taken a bold step forward by launching this unique offering. Perhaps it's a good opportunity to address some additional inquiries that our client may have. Just a quick introduction to everyone. This is a 3-year closed-end bond fund that primarily invests into Australian-denominated corporate bond that aims to pay between 5.5% to 6% return per annum. For Malaysian investor, such annual return from fixed income is considered relatively attractive. Roy, what are the attribution of this return? Does it include currency gain? Under what circumstances would you realize some of the potential capital gain, if any, before the fund maturity? And how you plan to reinvest the proceeds from disposal before the maturity of the fund?
Okay. Thanks, Nova. Uh, Hi, everyone. Yes, so that's a very good question. Yes, the fund's target return is a gross return of 5.5 to 6%. But this is a pure bond fund, so the return would be mainly a combination of income from the investments, i.e., the bond coupons, and the potential capital gains from the bond appreciation. Um, the target return, again, is in Aussie dollar and does not take into account the currency component yet. So any potential currency gain or loss will be reflected by the maturity of the fund. With the other question that you have, we advocate taking both a passive investment position in terms of positioning, but also active yield curve positioning to realize the capital gains early. The fund would sell assets that we feel have reached the peak value. And this would be a decision driven by factors like the rebalancing needs or profit taking opportunities. Um, the proceeds that we get from the disposal of assets would then be reinvested in other fixed income instruments that have the strong prospects to maintain or improve returns and to reduce the cash drag. But the focus again is on opportunities that align with the fund's overall investment objective, the target gross return, as well as the best interest of the fund.
Roy, I have opportunity to look into the fund's model portfolio and notice that the model portfolio indicate an average portfolio duration of around 7 years, while the closed-end bond fund is meant to mature in 3 years. What does this mean for investor when the portfolio duration is longer than the bond fund's maturity? Please share your interest rate scenario analysis that support your view for any potential capital gain, and what is the expected capital gain contribution to total return under each scenario.
This is a two-part question. So yes, as you rightly pointed out, the current portfolio duration is roughly around 7 years. We feel that this is the best tenor. It's a combination of short and medium maturities, which means like between 3 years to 10 years to limit the duration and rate risk overall, and also to achieve the target gross return of 5.5 to 6%. So RBA right now, the Reserve Bank of Australia, which is a central bank, is on the rate cutting cycle. It's just a lot shallower than before, and our house view, as well as the market consensus, could mean that there would be a rate cut potential of 25 to 50 basis points. which would then translate to a potential capital gain of 1.75% or 3.5% based on the current average portfolio duration as of the time of this podcast. For those that are not familiar, in general, when interest rates go up, bond prices will go down, and the opposite is true, where if the interest rates go down, the bond prices go higher, and that is what would be contributing to the capital gains of the portfolio.
Moving on is the question on the currency impact. Since the portfolio is in Aussie-denominated asset, but investors subscribe the fund in ringgit, FX move can materially influence both interim NAV and also the 3-year maturity outcome. Please quantify the expected FX return contribution and how will FX be reflected in the fund's total return.
Okay. For this fund, the class that it will be subscribed to will be ringgit. So the portfolio will definitely have exposure to currency risk because the main aim of the portfolio is to invest in Aussie dollar denominated bonds. So currency exposure will be the key consideration for investing in this portfolio. That being said, if the Aussie dollar remains stable or strengthens, not only do you lock in the decent yields, which Nova has already mentioned before, but you also get the currency gains as part of your total return, which is basically your yield and your currency effect. However, obviously, if the Aussie dollar weakens, that could into returns. So our current base case for Aussie ringgit, which is now trading at one of the all-time low of about 2.75 Aussie dollar to the ringgit. We think that the prevailing view and outlook over the next 2 to 3 years is that the Aussie dollar appreciates against the ringgit to 2.82, or basically a 2.38% currency gain. In your worst case scenario, it's basically twofold. If the Aussie dollar depreciates against the US dollar and simultaneously ringgit appreciates to 4.00 against US dollar or below, that would make it, let's say, if Aussie ringgit goes to 260, that would be a 5.67% currency loss roughly. And the best case scenario here is where the Aussie dollar appreciates against the ringgit and the ringgit depreciates further. So you've got one end where the Aussie is appreciating and ringgit depreciates. So we foresee ringgit going to 290 to 3.00. Basically, these were the historical levels back from 2020 to 2024. Then you will get a 5.2% to 8.55% currency gain alone. This is independent of the yield that you're already getting.
Right, the benefit for investing into a mutual fund bond is that it's diversified to multiple papers and also multiple sector. And I noticed that the portfolio has a diversified exposure to more than 50% into banks and electric combined. Please share your view on these sectors and the basis of focusing on this area. The average rating for the portfolio is BBB+. Does it mean some of the bond is below this rating? Can you share some insight and basis of inclusion into the portfolio?
I'll address it one by one. Number one, the sector concentration. So for fixed income, generally, we are agnostic of sector, which is not so relevant versus an equity portfolio. So in the fixed income space, governments tend to be the largest issuers of fixed income bonds because they need to fund public spending. And then banks or financial institutions tend to be the second largest because they need to raise capital to support operations and lend to clients. So for further context, if you look at any bond index, and in this case, this the Aussie dollar bond composite index, governments would form a 90% weight and financials only hold 5%. But if we look at the Aussie dollar bond credit index, where it strips out government issuers and supranationals, financials then become 42% weight on the index, while utilities hold a 10% weight. Overall, we are relatively well diversified across other sectors as well. In total, there will be about 6 to 8 sectors in the fund. But again, this is on the prevailing macro view that the RBA will continue to continue its rate cutting cycle, and they will benefit across regardless of sector. Now, with regard to the triple B plus, maybe I'll give you context. Triple B plus is a global rating, and for further context, our Malaysia bonds are rated A minus. This is the Malaysian sovereign. So triple B plus is still quite healthy into the investment grade space. And as you mentioned, that it's the average portfolio credit rating. There will be some bonds that are below BBB, and there are some bonds that will be above. We are focusing on that because we think that this is where the value is, because the credit spreads are wider at 100 to 200 basis points over the government bonds. While if you go further up the credit curve at AA and AAA, you will be getting returns of mid to high 3% only in terms of yield. Again, that being said, for this overall portfolio, more than 95% would be in investment grade bonds. There will be a very small nominal allocation to high yield at BB, just so that we get a further yield booster for the portfolio.
Okay, thanks, Roy. And this is my last question. The fund is a wholesale fund with exposure to foreign currency bond. Please spell out the ideal investor profile for this product. Any red flags that would make someone unsuitable?
The fund, as you rightly pointed out, is a fund with exposure to foreign currency and foreign bonds. So the ideal investor profile for this product is basically one that has already that wants to get foreign currency exposure, has already keen interest to diversify away from US dollar assets and look into other developed markets. So Australia is one of the remaining 9 AAA countries left in the world. Even the US has been downgraded to AA+. Further, in terms of the macroeconomic fundamentals, Australia's government debt to GDP ratio is one of the lowest at just 32%. And overall, they have solid macro fundamentals. Outside the dollar bond market and also in the Asia Pacific context, the Aussie dollar bond market is the next biggest market in terms of both the liquidity and depth of investors. So this is something that we want to take advantage of early, as it's still growing and has been growing since 2019. So again, recap this ideal investor profile is one that is keen on getting foreign currency exposure and wants to diversify away from US dollar and ringgit assets. As with rates higher for longer, we think Australia offers a unique value proposition, both in quality and value. And finally, I would like to end with the usual caveat that no investment is without risk. So therefore, Aussie dollar denominated bonds are also no exception. The investors in this fund would be exposed to Aussie ringgit exchange rate movements as well as interest rate and duration risk. So as with any bond portfolio, if interest rates end up rising in Australia, bond prices would fall. So if the red flag for the investor is the investor believes that RBA is actually done with the easing cycle, or i.e. the rate cut cycle, and that then they would be of the view that potential for price gains in the bonds would be limited. So again, the overall outlook for Aussie dollar is heavily premised on the economy, commodity prices, and the stability of their domestic policies. So if you think that Aussie dollar might underperform in the short run, then this would be a fund for you.
Okay, thank you again for joining us today. I trust with your insight, investor can make a better informed investment decision.
Thank you, Nova.
Dear investor, please get in touch with your relationship manager to see if this product is suitable for inclusion in your investment portfolio. See you again in our next podcast series.